When that lousy WeWork IPO correctly imploded in early September, all sorts of deals got postponed or canceled altogether. But sooner or later, they're going to be back. And tonight, we want to check in on one that was postponed. And it was kind of interesting. I'm talking about Endeavor. It's the parent company of WME, the talent agency formerly known as William Morris, along with IMG, the sports media and fashion company, and UFC. Yes, that's right, the professional mixed martial arts league that is so on fire. Full disclosure, I'm a client of William Morris, so I speak from experience when I say they are great at what they do. Now, Endeavor was supposed to come public late last year. They got pushed back, the deal, and the IPO market turned hostile. I think it was a very good decision to drop out. I'm betting they're going to be back, though, probably sooner rather than later, and a better price than they would have gotten during that big WeWork dive. And that's why we are thrilled to have Ari Emanuel, the CEO of Endeavor, here with us tonight. Mr. Emanuel, welcome to Mad Money. Great to see you, sir.
Hey, how are you?
Okay, so a lot of people just say you're a talent agency.
Right.
When I look through your financials, that's like a legacy view of your company, and yet we were somehow unable to change the dialogue. Why is that?
Well, you know, I think where you start is kind of how people see you. What we've done over the last, actually, March 29th will be 25 years. Well, we've changed the business into an operating business, kind of aware the dynamics because of the change of distribution going out in the marketplace in the entertainment business of how we operate. Most of our business at the time when we started, when Silver Lake came in, about 80% was in the representation business.
Right.
Like the sports or people in the entertainment business. About 5 years ago, we decided the mix would be better at 50% of the economics of the company, things we own, like the UFC or Freeze or things like that, and 50% of things we represent. So we're a very fluid business. But I understand it. I started in the agency business. There was a show about me. It's hard. So.
Well, the show about you was funny, and not necessarily, from what I can tell, accurate. But
back in the day.
Maybe so. But what I want to talk about is that I've always felt that you have a unique view and vision. If somebody wants to do something, you should take a stake in it.
Well, here's my opinion about it. You know, we don't have any legacy infrastructure. I don't have to defend a cable channel.
Right.
I think we're the best positioned company for where the entertainment business is going. So if you just take one vertical, the television business, there's a $150 billion ecosystem in the traditional business, whether it be ABC, CBS, USA, CNBC.
Right.
There's an additional $35 to $40 billion coming into the business, which is a third more money coming into the business every year over the next 5 years.
Right.
That's a really, just television, that's a really good place to be, and that's just domestic.
Right. And UFC, we know, has been a tremendous source of programming for someone that was able to make a lot of money with it. And you split that.
It was great on Fox.
Right.
We're having the best year we've ever had with ESPN and our partners at Disney and ESPN Plus. I think they're doing great too. So it's been incredible.
All right, so let's talk about what happened with the deal. I know that this Hollywood Reporter, I don't know whether maybe they are dealing with the guy who used to be looked like the old guy from the HBO show, but the dramatic last-minute decision to pull the plug on the IPO was not just an embarrassment. It was at least a temporary end to the hope of raising capital to pay down Endeavor's heavy debt, finance further expansion, created a morale problem for some 400 of Endeavor's 7,000 employees who hold shares, and have been convinced by the leadership to sit tight. Well, that's about as negative as they can. What do we say to the Hollywood Reporter?
Well, here's what I would say to you is, we got caught in this WeWork's growth overhang. We weren't like other people. We didn't have to go public. We were raising $500–600 million. Right. We've had average double-digit revenue growth, double-digit EBITDA growth. So we're doing well. If you saw recently, we hit our EBITDA numbers that we said in the filing. We hit it last year. We did the acquisition of On Location, which we'll talk about. Right. We gave a dividend to everybody at the company because we had the cash flow to do it. We'll de-lever based on just normal EBITDA growth, right? We're in really good shape. I was not gonna hurt my partners that invested in me and backed us by a bad IPO market.
Okay, so how about this acquisition, which was done when you were supposed to not have any money, according to Hollywood?
Correct. I guess they were wrong.
Right. And the acquisition, to me, seems to be a great way to be able to do a lot with sports, maybe even gambling.
Well, here's what I would say to you is, we're in business with the NFL. with one of the great assets of all time. The NFL kind of rolled their into our acquisition.
Rolled their what into?
Rolled equity into the deal.
Right.
And we now have a lot of events, whether it be UFC, fashion, into creating an experience business, starting with the Super Bowl and our partnership with the NFL, and all of our assets globally that we can bring to the table.
Is it possible that if or when you do try to come public again, that there's a shift in the amount of revenue that comes from agent versus programming that would make it so that you're a unique programming company at a time when the world is thirsty for programming?
Well, here's what I would say to you. 50% of our economics comes from representation. Okay. Locked in long-term deals.
Right.
And 50% comes from things that we own. You know, at one point you and I talked about in the medical area, a company that kind of had a balanced approach. Like, I forgot the name of the company that you and I discussed. We're the same way. We're flexible.
Right.
We look at things on a global basis. Sometimes we just represent it. Sometimes we've represented and then we acquire it, like the UFC, like bull riding, like Freeze. And that's the way we look at the business. And I think it's for where the world's going. I think we're best positioned as one of the guys best positioned in the entertainment.
I mean, I know that Abbott and AbbVie was the drug part and Abbott was the device part. And they just said, listen, we can make even more if they split it. I mean, to me, that's not the right time. You're building critical mass. You want to pay down debt. But it does occur to me that the idea that you are an agency is just the way it was.
It's a very small piece.
Right. And you're kind of like a software as a service business for entertainment.
Some of it is. Correct.
Which you could then accumulate more.
Yes.
And that would be the smartest way to be able to make a lot more money. And no one has that model.
It's very hard to be in this place to have that model.
Exactly right.
I don't think any of the major studios can do it. You know, they have to acquire their stuff. And listen, Disney has done a great job.
Right, they have.
In acquiring asset and growing their business.
And what happened to the old Ari from that TV show?
A lot of meditation.
Wow. Okay, I have to give that a try. That's Ari Emanuel, CEO of Endeavor. Again, they are my agent. I want to be very sure that you know that. They're private, but that's full disclosure because it's really important. We have Money's back after the break.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.